Good afternoon, everyone. My name is Michael Naidrich, and I am the co-CEO of Amerivet Securities. And as always, around Fed time, I am joined by my partner, CFA, all things Fed liquidity and rates, Gregory Faranello. How are you today, Greg?
Yeah, I'm good, Michael. It's good to be with you again. We're almost on 3 years.
It's incredible, pal. You know how much I enjoy doing this, and I think we should get right at it. This is another big meeting. I think what we should do here, Greg, is we should walk through the in-between meeting, the March liftoff to now and the rate call to start off 2022.
Yeah, no, that's great. Thank you, Michael. So, in March, we skewed toward 25. Obviously, I think the Fed was on the fence a little bit in terms of how that would actually play out. And I think the biggest change that we've seen really between meetings is the Fed stepping up their aggressiveness in terms of their tools that they have in terms of policy. So we know they have rates. We know they have balance sheet, which we expect them to announce this week as well in terms of how that's going to run off. But they also have outsized rate increases too. And if you go back to the last hiking cycle of 2015, the Fed was very methodical in terms of how they were raising interest rates in 25 basis point increments. And I think what you've really seen here short term, more so around inflation, is the Fed stepping up their game. We know there's 75 being thrown out there in some way, shape, or form, but we've gone from 25 increments to 50 within a short period of time.
Yeah, it's amazing how quickly it all changes. Greg, I'd like to focus in on the Fed and Chairman Powell and the communication because let's be honest, it cuts both ways from 21 to 22, and the Fed's moved the needle pretty significantly, doing not all that much. Can you opine on that, please?
Sure. So Jay Powell's Fed, the chairman's Fed, they're very focused on financial conditions. And if you look at financial conditions, you look at interest rates, we can look at real interest rates, which have moved a lot. You look at credit, which we talk about day to day on our Zooms and our calls. You look at the US dollar, which has obviously strengthened quite a bit. And you look at equities too, which relatively speaking, I know there's some volatility in the marketplace. The Fed is very focused on financial conditions, and they've moved financial conditions. I would say if you come out of last year, late last year, we looked at the market and said, look, things are mispriced here. They're not moving financial conditions. And I think what you've seen really to start this year, you've seen financial conditions tighten. But I will say, Mike, if you look at financial conditions, relatively speaking, going back over time, the Fed still, I think, has a lot of work to do here. So financial conditions have tightened. Now they have to deliver. But we think they have some room here to work toward tightening financial conditions even tighter.
Makes sense. I'd like to now focus in on the yield curve. And credit to you, you've had a really strong call here. There's been a lot of volatility of late. How does the Fed look at this versus the market narrative in general?
Sure. So the Fed looks at the yield curve in terms of what's going on at the very short end of the yield curve. If you look at the very, very short end of the yield curve, you see interest rates are really, really low. And then if you look at just say the 10-year part of the curve, there's a very steep slope there, right? So if you look at 3-month T-bills, if you look at the 10-year note, you're seeing a very, very steep slope, especially on a day like today where we're approaching 3%. The differential there is, and a lot of people like to look at the 2s10s curve, and we do. There are a lot of different ways to look at the curve and what it means for the economy. But in the end, the Fed hasn't done anything yet. I mean, that's the reality. So we've gotten a 25 basis point increment in March. They're going to start to catch up here. What you're going to start to see is that very, very short end of the yield curve. You're going to start to see that curve start to flatten out over time. And I think that's what the market is looking at here. If you look at 10-year yields, if you look at that 3-month curve right now, over time now, as the Fed really starts kicking into gear, you're going to see that curve start to flatten out.
Gotcha. In talking to our clients, a lot of talk about the terminal rate versus the neutral and the current market pricing. Is the Fed going to break something here on this?
Well, we certainly hope not, right? I mean, look, we've got a great economy. We don't want to see the Fed break anything here, and I don't think they I don't think they want to either. If you look at what Chair Powell has done really for the economy over the last couple of years, he's not looking to break anything here, but they are definitely behind the curve. So neutral and terminal in the end, they should be one and the same, but it never works that way. If you look back to 2018, we know that to be the case. So the Fed talks about moving expeditiously toward this neutral rate, which they have theoretically at, call it 2.4, somewhere between 2 and 2.5%. If you look at the terminal rate, and that's been where there's been a lot of volatility, that's now anywhere from 3 to 3.25%. So the terminal rate is ultimately what the market is saying. Where do we end this whole thing? Where does this slow down? And I think the answer, Mike, is we just don't know. And that's why there's a lot of volatility in the marketplace. I don't really think the Fed knows where neutral is. It's a theoretical, unobservable rate. And I don't think anyone really knows. So they are going to move here. I think they're going to move methodically. In their words, we have certainly endorsed that. And I think we're going to find out over time where things shake out in terms of not only inflation, but how the economy evolves.
So are we sticking with 50 basis points this time around?
We are, my friend. Yes.
All right,
yes,
good. So you're feeling good about that.
I am feeling good about 50. Yes.
Okay. As long as we have a couple more seconds here, I'd love to ask you a couple other things. That recession word keeps popping up, and a lot of people are saying maybe 2023. You have a thought on that?
Yeah. So I think it's really hard to predict. I think the economy is actually in pretty good shape. I think globally, if you look at it right now, there are certainly there are red flags out there. There is no question about it. When you look at Ukraine, you look at Russia, but you look at what China is doing, right? I mean, they have transitioned their economy, or they're trying to. They're easing policy. I look at currency markets really across the globe. And if you look at the dollar, if you look at the yen, it's a big part of the treasury market too now, in terms of one of the biggest buyers, the biggest owner of assets in terms of treasury assets, holding on to yield curve control. So I think the Fed I think they're in a tough spot here. They're going to have to balance it out. I don't see recession right here, right in front of me right now. At some point, and yield curves don't create recessions. At some point, they are certainly indicative in terms of what could happen down the road. But I still see this as a very, very good economy, despite what the yield curve is doing. And we saw this back in 2019 when we were fighting the tariff war with China. The yield curve inverted, and then we re-steepened out, and things were good. We couldn't predict that COVID was going to hit us, but I like the U.S. economy here in general.
Yeah, the economy is interesting, right? I mean, you see more employers making concessions to employees, whether it's coming back to the office. So I think Airbnb went full-time remote if you want. I think, if you look at, just on LinkedIn alone, the amount of people switching jobs because there's a lot of great offers out there. Is the labor market a concern to you?
Well, it shouldn't be a concern, because I think it's a good thing in the end. I think those dynamics they're good dynamics. We haven't seen these dynamics in a long, long time. And but the challenge is real wages are not going up because they're not going up because of inflation. So ultimately, what we really need to do is balance this out. I think that's the big challenge for the Fed, because right now, if you look at this employment market, there is certainly an imbalance. Like there are imbalances with everything that we're looking at, but we can't hurt the labor market in the end. I mean, I think the U.S. consumer, the trajectory that we've seen here, I think is very, very constructive. I think it's how do we balance this out over time? But look, at the end of the day, people being employed, people sitting down in seats, people getting jobs, people having the ability to have jobs, that's a beautiful thing for this country right now.
That's everything we're supposed to be, which is nice to see. So, Greg, listen, my favorite part is not only the day-to-day grind of what you do, and congratulations on some more great media time on Bloomberg the other day. And I know you're going to be on Fox, I believe, on Fed Day on Wednesday. But, I love when you dive into after the Fed announces and you go into Chairman Powell's notes and you really help our clients understand, the trends of how they're thinking. So super grateful. This means a lot to me 3 years later. So I thank you, as always, for sitting down. And of course, if any of our clients would like to speak to Greg, like many of you do, please call your AmeriVet representative and we'll make sure that happens. So wish everyone's families well and have a wonderful week.